Hi, everybody. Can you hear me? Just checking to make sure you can hear me. Awesome. Now I'm going to do something terrible. I'm going to see if you can see me. All right. Got the video. Well, sorry, I can't do anything about the face. It's all I forgot. All right. So let's see if we can make this class work. Hope everybody can see my desktop. Everybody see everything all right? Come on now. I think it's the first time I've done it. All right. Well, here's the good news. It's the last time you have to listen to me this semester. The bad news is it's been a really good semester. You guys have been great. We've had a great class. Sorry for all the technical problems we had. I think we had problems in this class. We spent so much time just helping people with, can't get access to the classes and all the kind of the technical stuff, and so I'm kind of sorry about that, and we didn't spend more time on actual coursework. But been a great class, and I think we've just had some great outcomes, and the class overall seems to be doing extremely well. So I hope everybody's happy. All right, so let's roll into what we've got doing. Once again, we had a great class this semester. You are encouraged to fill out your course evaluations through your MyLeo portal, and I'm assuming they're going to send you an email or something, or you can look at MyLeo. But the idea is please fill it out, your evaluations. Your homework this week is going to be in asimplemodel.com. It is a website that just does nothing but teach you in a very simple and highly understandable fashion how to build a simple financial model. It is essential that you know how to build a simple financial model. You don't necessarily have to know how to build a great, big, huge one until you get into upper coursework, if that's what you decide to do. But no matter what you're doing in business, you need to know how to do this. And you may not ever, have had to do that until the time you get to your next course. It's a lot harder than this one. It's a lot more detailed, and you're going to go, where in the world do I start? And you are going to have a resource for the rest of your college career, your business career, as a place to go get started on how to build a financial model on a business. It's a skill I want you to know how to do, and so I really highly suggest that once you get there, you bookmark the site, you keep it, you know it, you own it, and it's also a great learning tool. There's a lot more to it than what we're going to spend our time on. We're just going to barely scratch the surface of what this site can do for you and your life and your career. But the point is I want you to log into the website, and I would like for you to walk through two sections of this. It will look like this, and here is the front page of the website of simplemodel.com, and I want you to go through two sections: integration to financial statements and integrating financial statements. There's a quiz that you will take on integrating financial statements, but I want you to go through Introduction to Financial Statements and Integrating Financial Statements. It's a series of videos, and you just watch the videos, and then at the end there's a quiz you have to take that shows that you paid attention, you know what they're saying here. Take a screenshot of that, either on your, on your desktop, email it in, take a picture of it with your phone, email it in to me and Bo, and that will, the grade that you get on the quiz on this website will be the grade that you will get for your homework. Okay? So once again, we're trying to teach you tools and things that will be valuable to you into the future, both in your coursework in the future and in your life in business. And once again, if you scroll down on this website down to the bottom, you will see that we are not only going, we're only going to scratch Introduction to Financial Statements and Integrating Financial Statements, but they also have 6 videos for discounted cash flow, 11 videos on leveraged buyout model, business development, and Excel for models. This is a great tools and tips section right here that I highly recommend everybody go through and understand. So it's a great resource for you, and you can see that this is being used by people all over the world here, and including the original university that helped them get this started was Texas A&M University at Commerce, because the guy that built this website is a friend of mine. Okay, so this is a real deal, and I highly recommend you spend your time on it. If you spend some time on here, you will see quotes from students at Texas A&M Commerce, probably a quote from me in here, and just all kinds of things that you could continue to learn from this website. So I want you to have this in your repertoire. Okay, that will be your homework. If there's any questions, email me, email Bo, but it should be fairly simple. It's just you go on there, you watch the videos, and you take a quiz, and you send in a screenshot of your score, and then there's your test on your homework. Pretty simple. The next thing you need to be thinking about, the next thing you need to be worried about is your final exam. After we have this course, we will open up the final at the regular time on Tuesday the 5th. It will be closed on Tuesday the 12th. Period, bar none. We might open it up early for you, so you have more time to do it, but I just really don't feel like I can cut it off sooner. But I'm going to give you a really big hint. It's in bold and underlined it with 3 exclamation marks, which is you need to spend extra time on time value of money. Time value of money. If it was me, I would go back and read that chapter. Just read it, and then look at whatever we did when we did it. And if I gave you any exercises or anything like that, you remember that quiz we gave you around time value of money? You might take a look at that again. But that's really the kind of stuff you're going to need to know. You'll be a little bit heavy on that. If you're going to get bogged down in the final, it'll be bogged down on, oh my gosh, that was 4 or 5 weeks ago. I forgot how to calculate all of that stuff. So if you'll refresh your brain, it will be easier. Once again, it's open book like everything else. You have an entire week to accomplish this. It's going to be, you've had about 25 questions every other week. This is going to be closer to 140 questions. So whatever you've had, you've got to multiply those 25 times, I guess 6 essentially, and however long it's taken you, that's how long it will take you to complete this final exam. It is comprehensive, so it will cover, there will be questions on every single chapter. So be prepared for that. Just wanted to give you a heads up. Now, back to financial planning and forecasting. Really, what the heck do you need that for? I'm going to run a business. Excuse me, I've got to turn on the fan. It's hot in here. I've got to run a business. What do I need to know what it's going to be? Don't I need to know what it is? Well, no, you need to know what it's going to be so you know how to plan. You need to know if you have the right capital, if you have the right resources, if you have the right number of employees. Do you need to raise capital? Do you need to raise debt? Should you pay off some debt? Do you have enough money to take money out and put some in your pocket through a dividend to the owners? I don't know what the answer is, but you need to have a forecast. So what do? Most big companies, they would start out with a mission statement. At Dasky, we are building North America's premier open deck trucking company. Right? The company talks about its corporate scope. How big are you going? How far are you going? How are you going about it? What are the objectives that you hope to meet? What are the strategies that you're going to deploy to achieve this strategic plan? What's the operating plan to get there? And then the last component of that really is a financial plan. Now, you can do a lot of things, but at the end of the day, the number one thing you have to have is you got to know where you're going, so you have to have a plan. You don't get in your car and start driving to Minneapolis if you don't know how to get there. You look at a map, or you have Google tell you, or something. You find a way to somebody that tells you to have a plan, but you have to have a sense of where you're going. If you don't know where you're going, how are you going to know where you're going to get there? So there all has to be a plan. I think the fundamental building block is a financial plan, but when done right, it's the last thing after the company has gone through all of these kinds of activities to determine what that is that they were trying to accomplish and how they think they can get there. Now, the next part is, okay, well, that's really fancy and nice, but where in the heck do we start? What do we do? What's next? And the real answer is you start with sales and labor. So let's talk about sales for a minute. The simplest thing is to look at historical trends. And when you go to a simplemodel.com, the first thing you're going to do is start with historical trends. Now, what's happened in the past is not a predictor of what will happen in the future, but it's a really good starting place. It's a great place to get your arms around, hey, what happened here and what's going to happen? And so you need to think about what's going on with your sales teams, what's going on with your customers, what's going on with the economy. You need to think about seasonality. In my business, you know, there's a pretty heavy degree of seasonality to the business that I'm in. And so you need to think about that. Are you going to run any new products? Well, maybe. I've been selling Coke, Diet Coke, been selling Diet Coke Lime. Now I'm going to sell Coke Free with lime. Well, if I do that, will that cannibalize the sales from the Coke I've already have been selling? Or are they incremental sales? If I sell Cherry Coke with lime, sugar-free, that may be a new product. Is that something completely different? Or if you're selling Cherry Coke and you start selling Cherry Limeade, it may not cannibalize your sales at all. But you have to think about what's happening with your product. What are you doing? What are you selling? You also need to think about new markets. Like we've talked about before, Whataburger's doing really well in Texas, but can we sell Whataburgers in Nebraska? If so, we're going to roll out to a new market and we're going to try and sell Whataburgers in Nebraska. Are you going to make any new investments? Meaning, are you going to buy any new businesses? Are you going to expand your operations? Are you going to expand your production facilities? What are you doing here? Are you buying? Are you divesting a division? So what's happening around your sales front? But really, you need a lot of input from your sales teams, and usually they're going to want to sandbag you. I've never seen a sales team that was really comfortable with forecasting, but they have to do it. Somebody has to do it. What are you going to do? You're going to do it. You're the finance person. You're going to do it? Well, how do you know? You're not out talking to the customers. They are, so they have to do it. So you have to get a really good forecast of the feel from the teams as what we really think is happening out there in the real world, right? And then the next thing you've got to figure out is, okay, what's going to cost me to deliver it? A lot of things are fairly fixed and happen on a fairly constant basis. You pay the same amount of rent every month. You probably have the same amount of debt service on your notes every month. But two things that are very variable, I said that, are sales and labor. So labor would be the next thing you need to worry about. So once again, what's happening in historical trends in labor? You got to think about the seasonality, the number of payroll periods in a month, and all those kinds of things. But are you planning on hiring new people? Are you planning on expanding in new markets? Are you going to acquire any more business units? Or are you going to sell a business unit that you have? All of that would go into a labor forecast, right? And then once you do all of that, you need to figure out, do I need any more money to accomplish that? Probably, if you're growing, right? So sales don't just happen. You have to make an investment in them. So, they oftentimes need support. You may have to spend CapEx to get there. You might have to build a new building. You might have to build a new Whataburger. Or maybe you're only open for breakfast and lunch, and now you're going to be open for dinner, or you're open for breakfast, lunch, and dinner, now you're going to be open overnight. I don't know what the answer is, but oftentimes if you're going to do that, you need to spend some money. Sometimes you get, money just kinds of spontaneous increases, the book calls it, and the money just shows up in your lap. But frankly, if you have earnings, that can help fund a great deal. I've told you about the pizza places that I'm a part of, and we're growing, and we're doing that out of earnings. We're growing the business out of the earnings of the business as opposed to finding it from somewhere else. But you do need to calculate how much capital does it take to accomplish this plan. Do I have additional funds that I need to be able to accomplish those sales, to buy that new business, to go to new markets, or introduce new products, etc.? Now, I'm a little crazy, but look, if you want to do it right, most people only do one thing. They forecast an income statement. Okay, fine, but it's weak. But okay, that's what most people do. And if that's all you do, fine. It's better than nothing, trust me. But the right way to do it is have an income statement and a balance sheet, because once again, as we said above here, sales do not occur in a vacuum. So if you're going to sell more, you may have to buy more inventory. You may have to borrow money. You may have to do several things to get to the income. And so if all you do is 2 statements, that's good. That's pretty good. That's more than most, but that's a much more complete look and understanding of your business when you forecast both the income statement and the balance sheet, right? So and then if you're really good, you'll balance you'll forecast a full 3-statement model, which includes cash flow. And I think you know me well enough to know by now that as a CFO type person, I'm big on cash, and I want to know what the cash generation is going to be of that particular unit, that business, whatever. I want to know about the cash. I'm running the business here. I need to know about the cash. It's not just about the GAAP earnings, right? So I want to know about all 3 of those. But if you only do income statement, that's better than nothing. If you do income statement and balance sheet, that's pretty good, and it's better than most. But if you really want to do it right, you do all 3 statements. Now, so how do you go about forecasting a financial statement? Really? Well, number one, you go to simplemodel.com and do what they say. But really what you ought to do is the right way to do this is, I believe, you're going to want to, as you look through your crystal ball in the future and determine what's going to happen in this business, you're going to want to toggle some switches. You're going to want to, what if this program, so what if our sales grew a 3% rate? What if our sales grew at a 5% rate? What if I had to give pay increases to 5% across the board to all my people? What if I only had to give pay increases to the line cooks? I don't know, but you're going to want to be able to vary it and tweak it to build your plan. So at the very basic level, I would put a variable input for a percentage or a dollar of sales growth. That could be up or down. Let's say you're doing, you got 10 Whataburgers, you're going to sell one, so at the end of next year you're only going to have 9. But you're going to have a sales number, so you're going to want to vary, how many of those that you want to have. Operating cost, typically, people would look at a percentage increase in operating cost. What's happening on your debt, and how much can you withstand, and what do you think is appropriate? Variable inputs could be taxes. What do you think is going to happen on the taxes? But fixed inputs are much more like fixed cost. The things you know are going to be there every month regardless. Rent, insurance, your debt service, assuming you don't borrow any more money, and of course the most important thing, management salaries, right? So what are the variable inputs, what are the fixed inputs, because you want to build a model that you can just, if you can put them, frankly I like to put them on a separate tab of Excel. I like my people to put them on a separate tab of Excel with some very basic outputs for models. So what's net income, what's EBITDA, what's my current ratio, and what are my debt ratios, so that when I change toggle these switches, the model gives me a very, really cursory look real fast at, what's happening to my revenues, my earnings, the basics of my balance sheet. And then when I see that, then I can go back into the more detailed section of the spreadsheet and understand what's happening. Now, ratios are really important to build it, and I like to build them their own section, either their own tab or at the bottom of the sheet. And I like the way they do it on simplemodel.com, where it's really kind of one sheet and it all ties together. But you want to know what to do. Remember last week we talked about working capital, and you want to know, does this affect your AR policy? Do you need to collect more quickly so you don't have to go borrow money, or can you be more lenient on your terms so that you can have more sales? It should help you determine your inventory levels, if you can afford CapEx, if you have to do CapEx. You want to make sure that whatever you do in your forecast keeps you in compliance of your debt covenants. So I would put whatever those covenants are. I've got 2 or 3 examples here on the PowerPoint of what those typically are. But whatever it is that your debt covenants are, you're going to want to measure that in your forecast going forward. So what would that look like? And in this particular deal, we've got this is a preliminary forecast. And the company has come in and they've got here's their 2014 actuals, and this is what their 2015 estimate is. And so their sales are growing fairly significantly from $2 million to $2.5 million. Their variable costs related to that are also going up, from $1.2 million to $1.5 million. Their fixed costs are going up as well. So they probably borrowed some money, or they rented a new space for a new Whataburger or whatever, but their interest hasn't changed. Wow, they did not borrow money to get this done. So I'm going to want to understand, okay, how am I going to finance all of this growth without borrowing any money? Earnings also likewise have gone up significantly, but my taxes are still at 40%, so they eat into those earnings, but still my earnings have gone up a fairly sizable amount. And I have a dividend policy of 30% of net income, so I'm going to pay out, $19.62 of of the $65,000 here. I'm going to pay out, $19,000 or $20,000, and I'm going to put $46,000 or $460,000 into, I guess that's $46,000 into retained earnings, right? Well, remember, this is a preliminary forecast. So we kind of put together our forecast of finance. We've taken the input from sales and what we think is going to labor, expansion, contraction, whatever we're going to do. We put it into a model, and we're going to go through a couple of preliminary statements, and then we're going to see what it looks like afterwards. So once again, it looks like I didn't change the dates here, so don't get confused. I mean these just to be the same years. Cash is, $20 going to $25. Our accounts receivables are going up because we're selling more. Now we had to invest in inventories. Well, here's more money that I had to put in inventory. But if you recall on the prior sheet, it didn't look like I borrowed any money. Maybe I just got a dramatic lowering of my interest rate, which is not likely. But so once again, and I've made a significant investment in fixed assets, so that had to be financed somehow. So there's a lot going on the asset side of the balance sheet. Well, let's see what's going on the liabilities and equity section of the balance sheet. You would expect the AP to go up, which it has. The notes payable have gone up by that much, but the interest didn't go up. I'm not sure I understand that. But my total current liabilities are up. My long-term debt is up. My common stock has not gone up, but once again, to those retained earnings that went up, they went up. So we have borrowed money, but the interest did not go up, so that kind of confused me a little bit. So what we would look at then is what's happening on our key financial ratios to try and understand the implications of that, to tell us how we compare to ourselves and to the industry at large. And so you would take whatever the metrics are that are important to your business, and they are different in every business and every industry, so you just kind of have to learn what makes the most sense for you for a KPI, a key profit indicator, and that's finance word of the week, KPI, if I haven't used it before. And so what is it that you want to know? What's in my business, what's my revenue per truck per week? So is that good or bad compared to the marketplace? So what's my profit margin? It looks like I'm only making about 2.5% even after all of my improvements. The industry is at 4%. My return on equity is, roughly 8%. The industry is roughly double that. I'm still having these real slow collections when the industry is collecting really quickly. And the industry's turning over better than we are. Our fixed assets aren't turning over well, and our total assets aren't turning over. But our debt to assets is really good, so we're better than everybody else. Well, not necessarily better, we were, but now that we borrowed this extra money, we're above, but we're okay. And then our payout ratio of our dividends is good. But the point is that we really want to look and see how we're doing against ourselves in a trend and against everybody else. And this will tell us a lot about our financial plan once we actually start analyzing the financial statements that we have assembled. So if you're going to have a preliminary forecast, you're going to want to know about your working capital as well. So at what percentage were you operating? In this case, we'll say, for example, we were operating at full capacity. We were have as many Whataburgers being turned off the line as we possibly could in an hour's time. That each asset is going to grow proportionally with sales. So our inventory goes up in a proportion to the amount of sales, which may or may not be true. The payables and accruals grow proportionally with sales. That may or may not be true. But you have to have a starting place, and this is a great place to start. Just do it in proportion. Right? And then you look at it and see if it makes any sense. You look at the profit margins and the payouts and see if you can maintain those same amount. But still, once again, sales were increasing by 500 million, and in this case, I think it was $500,000, the way I rounded the numbers. But you got to have some assumptions, and you have to make a list so people can see the assumptions you made when you made this forecast. So a forecast without assumptions are like, well, where did they get this number? Why did they use that? So if you have a little simple list of the key assumptions, and I like to have them right up there by those toggles as well. So somebody's coming in and they're just trying to get the big picture and not get granular the way you are in building the model, can see what you used to come up with your logic to come up with your forecast. Once again, you need to figure out if you need any more money to do it. And then when you're finished with that, you will go in and you will show it to management, and they will review the financial forecast, typically, right? That's the way it works. So in my company, our manager of FP&A, Financial Planning and Analysis, Financial Word of the Week number 2, Texas A&M Commerce graduate, by the way, would come in and give me each individual operating unit would build their budget, would present it to him. He would go through a series of reviews of their budget, phone calls with them to understand what their assumptions were, what they were thinking, and then get that into a more refined status, and then bring it to me for me to review, and for me and other senior managers to opine as to whether we think this is a good idea, bad idea, this makes sense, doesn't make sense, we're going to do this, I'm not doing that, whatever it is. And so they will come back, and in this case, management, the example we're using here is management has reviewed it, and they've come back with some following revisions. They think the customers will pay quicker, and that we can reduce our DSO to 34 days, and we're actually going to have to spend a little more on that new facility, not by 500 million, but 700 million. But we're going to be able to, we've got this new inventory system, this new software, we're going to be able to increase our turnover dramatically without affecting 1 penny of sales. So those are some big assumptions that came from management. They will lead to adjustments, and the finance team's going to go back and adjust the model based upon this input from management. So now we've taken this management, let's look at what we think is a little bit more closely aligned to a revised or final forecast. Well, the cash is going to go up. The accounts receivables went down. What do you think about that? Oh, yeah. I sped up how quickly I collected. So now I'm generating cash from collections, and therefore my receivables are not going to go up at the same pace that they might have otherwise. Our inventories are a little higher, and our fixed assets are bigger than the number that we had discussed before. Right? And therefore your financial forecast, while it is still poor in some categories, is certainly better in others, particularly around inventory turnover, day sales outstanding, and that really goes back to this dramatic improvement in cash on hand. Right? So we went back and we ended up with a better forecast, with a better run company, with a better result, with a better roadmap to success, because I'm telling you, throughout the year, people are going to come back to this forecast and judge how well they did. Now, I really didn't get into this because I don't want to confuse you, but there really are two different things. There's a budget and there's a forecast, and they're not the same thing. A budget is a kind of an immutable number that's set at the first of the year that you tell if you won or lost, you succeeded or didn't, based upon your expectations for the company and what you expected to achieve. That's the budget. The forecast should change every time you get new information, so it should be constantly updating. You're just forecasting. You didn't know where you are, what you really think is going to happen, which is a little bit different than a budget. You won't get tested on that, but it's important to know the distinction if possible. So those are really the key concepts that I want you to know here. You know, you're going to need to know what's the net investment in the capital. Probably not, you won't have to calculate that for a test or anything. Once again, I'm always going to focus on cash flows and free cash flows as a business person, but not as somebody giving you a test on a quiz. I'm going to want to know, okay, you know, what's happening on efficiency, utilization, what are my utilization rates, you know, all those kinds of things. What's happening on the forecast sales? Do I have excess capacity? Can I do something with it? Is it dragging down my ratios? All of those kinds of things. And then if I make any and all of those changes, how does that affect my additional funds needed calculation? Okay, so that's it. That's it for the semester. That's it for me tonight. Does anybody have any questions? Most of this will become, I know it's kind of muddy right now, but I would say that it is will become very clear when you spend time with the model. Okay. Anybody else? Thank you for being on the live broadcast, because you know, when people ask questions, I think it helps the others. Okay, y'all. Thanks a lot, and good luck on your final, and good luck on the simplemodel.com.